Immediately increase your investment returns with this one simple trick. This is not clickbait. This is literally this simple. It's going to be a simple trick, and you're going to make a hell of a lot more money if you don't do this. I talk to one or two people every day, and I can't believe I don't think I've done this video, at least it's for not a year, and I cannot believe how many people are sitting in stable value funds and cash accounts at the bank. So I just got off the horn with, we'll call him Georgie Porgy today from PA. Georgie Porgy from PA. Actually, no, I want to use another guy. We'll call him Charles in Charge from California. He's Charles in Charge. Now, this 6 months or so ago, and he's got like 500,000 in his Chase account. And I said, so let's take a look at Chase. So here's Chase. Let's see what, do they not give us a chance to see what the rates are? Let's see what Chase's rates are here. Hang on one sec. So what we got right here? See, oh boy, I got to enter my zip code. I'm in Fulton County, baby, where my taxer is going to prosecute Trump. Take that, Drump. We're prosecuting you here, Drump. My tax is going to use, of course, that was never part of an election, but so here we go. All balances, 0.01%. It's 1 basis point. That's freaking fantastic. That is, you can't beat that. It's Chase Savings. Let's actually look at a Navy Federal Credit Union. A member of Navy Federal is the biggest credit union by far. So let's see what their rates are doing here. Savings rates. Can we just click on that? All right, let's see what they got. All right here. 0.25. That's great. 0.25. That's fantastic. We got the money market savings rates. Over 50,000, 1.5. Jumbo money market savings rates, 2.25, and that's with over 1 million schmackaroonies. All right, so this is across the board, dude. In fact, let's look at USA. Doesn't give us the rates here. So, hey, whatever. That's all right, because we should just give the rates. All right, whatever. Doesn't give us rates. All right, the point being is, so I was talking to my man. So Charles in Charge. I said, Charles in Charge, man. You got to move that money to a money market account. He had a Schwab account, a Fidelity account. So just move it over to SPACs. SPACs. I mean, no, it's not FDIC insured, but you're making 5% in SPACs. You're making 10 basis points in this account right here. Are you taking on more risk? And in fact, if you look at my man I just talked to today, Georgie Porgy, 126,000 sitting in his bank account, hardly earning anything. He goes, what should I do with it? Move it to this right here. He already has this Vanguard Federal Money Market Fund. 5.27. 5.27. That's $5,200 a year. Federal Money Market Fund. There was a video that said 7 reasons not to have the Vanguard Money Market Fund, or as an article. And actually, I'm going to see if I can't find that. But government product type, taxable money market fund. Taxable money market fund, government product type. Let's see what the holdings are. So everyone says FDIC is more guaranteed than federal bonds. It's just not true. It's just not true. So they got 222 holdings, 39 days is the average life, 10 days average maturity. All right. Risks associated with conservative funds. All right. The share price are expected to remain stable. All right. Keep in mind, investments that offer stability principally typically are the most vulnerable to income risks, i.e., you've lost your income from inflation. Well, we're getting 5.27, man. That's not too shabby. And they tend to produce lower long-term results than riskier assets. Such funds are appropriate for the short-term reserve portion of the long-term investment portfolio. Yep. And investors whose tolerance for share price fluctuations is very low, or whose employment or financial situation is precarious, i.e., you're getting ready to retire, 100%. And you can see here, U.S. government obligations right here, 32%. Repurchase agreements. Oh my goodness, the repurchase numbers, don't you know? Let's see what the guy said about the reasons not to own the federal money market, if I could find that video. There it is, 8 reasons not to own. And this is actually a pretty good article. I got to make it so I can read it. I don't have my reading specs. The much advertised fund we just looked at, it takes the fund's accrued interest over the last week and multiplies by 52. It does not accurately represent the investor's expected annual return in the way bond funds do it. Yeah, it certainly does, man. I mean, we're getting right now, we are getting 5.27 is the last 7 days. Yeah, if you're expecting more or less than that, I'd wonder why you'd expect more or less. I mean, I guess you'd expect less if you think that the rates are going to be cut, but we don't think the rates are going to be cut anytime soon, especially when the new inflation numbers come out. According to December 2030 Fed dot plot, the U.S. Reserve is projecting the Fed funds rate to decline by 2.5 percentage points by the end of 2026. Okay, that's fine. So it's still higher than what the bank is paying. It's not as safe as investors believe. Only 32% of it is investment in U.S. Treasury obligations. The rest were repurchase and agency obligations, two sectors previously bailed out by the U.S. government. And so the alternative to that would be the FDIC. Because what is the FDIC? Oh, the FDIC doesn't have. He's not making this argument. I'm making this argument. The FDIC, when it bailed out, it's not saying Bankman, whatever the hell that bank was, I forgot what it's called. They just bailed out another bank too. Was there enough money in the FDIC to pay for these banks' bailouts? No, it wasn't. It was bailed out by who? The federal government. So if that were to happen in a Vanguard or Fidelity money market account, we're all doomed anyway. It's just all there is to it. So, I mean, that's a legit argument. I mean, they're not 100% government obligations. And these, you can say, two sectors previously bailed out. Agency obligations, Fannie Mae, and I don't even know if they have any Fannie Mae, was certainly bailed out. It should have went bankrupt, but it didn't. Water under the bridge now. Ginnie Mae, I don't even know if they have any Ginnie Mae in there. I just don't know. But those are agency obligations. Ginnie Mae, Fannie Mae, Freddie Mac, Federal Home Loan Bank, and whatnot. Just because someone's been bailed out before doesn't inherently mean it's more riskier than a bond in particular, or more riskier in terms of interest payments. It doesn't mean that. But yeah, I mean, 100%. And I just think FDIC, we're talking about a bank here. FDIC is the Federal Deposit Insurance Corporation. Who guarantees that? The federal government. So when FDIC doesn't have enough to cover its cost, what happens? The federal government bails out. So this guy's argument, and it's a right argument, would be you shouldn't buy FDIC invested things either because the federal government bails it out. It's not a fixed sum investment, given its ultra short-term nature, lack of visibility. Yeah, we don't know what's going to pay in the future. I get that. That's in of itself. That's any kind of cash cow. We don't know what's going to pay in the future. The management fee is understated. Does not include the significant transaction costs. Yeah, I get that. Vanguard is this is what I don't like. And Vanguard is fined and censured by FINRA for overstating projected yields on annual income on 9 money market funds. Well, they're not overstating annual yields. They're just saying that the last 7 days, if we annualize that, is 5.27. And you can see kind of going down here, right here, the daily market value, net shareholder account. You can see what the daily liquid assets, weekly liquid assets, daily market value. I mean, it risks everything you do. Vanguard website misleads investors by indicating that as of January, 30% were government obligations when instead these were federal home loan banks. I don't know about that. There are compelling alternatives of Vanguard money market that offer investors higher potential returns. That's what we're seeking. Fixed coupons for longer durations. Fixed coupons with longer durations. That has more risks than the Vanguard money market. That's for sure in terms of volatility and potentially even the ability for it to be made whole upon maturity. We don't know. Anyway, I don't have any problem with that guy's article. I just find it, it's a little bit, I think we're reaching a little bit there, but it's okay. It's a good article to read. Either way, your bank is FDIC insured, and the FDIC was bailed out. And so if you're getting 10 basis points at your bank, you freaking look at money market account, dude. 100%. I mean, you don't have to do that. But in this case, my man, Georgie Porgy, would you stop saying that? No, I like saying it. It's fun. Georgie Porgy. Curious Georgie. Anyway, he's getting 0.1 or something like that, and that's paying him $100 on $100,000. He could get $5,270 on $100,000. Now, can I guarantee that'll be the rest of the case for the whole year? No, but right now, that's what it's paying. Not too shabby. All right, love your thoughts. God bless. We'll see you.